So we've made it to the fourth part of the Investing with Vanguard series, and I've really enjoyed making this. I really hope it's been helpful for people, and if you've watched all of the videos to date, so parts 1, 2 and 3, and now you're watching part 4, you by now are pretty well versed with Vanguard. And so if you have an account with them or you're thinking about opening an account with them, then I think you're in a good place to make some informed decisions. Of course, I would recommend for you to continue doing more research into Vanguard for you to figure out which funds are good for you and if this is the investment platform that you think you should use moving forward. If you're new to this channel, then welcome, and for new subscribers, welcome to my channel. I'm so glad to have you. It's really great to see new people joining me on this channel and leaving comments and engaging with me. So if you are new, then of course, please do write a comment down below and let me know what you think, and I'd love to interact with you. So for this fourth and final part of the series, I'm going to be going through an investor information sheet. So an investor information sheet is a bunch of information that is relevant to a particular fund that you'd be investing in. So whether this is a blended fund or an equity fund or even a fixed income fund, there will be an investor information sheet per fund on Vanguard. So today I'm not going to take you through each one because we would be here for days, but I'm going to take you through the FTSE 100 investor information sheet just as an example, and I'm going to go through some of the points that you should be looking out for and some of the things that you should be considering when you are looking at a fund and considering whether you are going to invest in it or not. Okay, so hopefully you should be able to see my screen, and as I said, this is the Vanguard FTSE 100 ETF fund. So we're going to just look through what this information sheet includes. Of course, you're probably looking at this and thinking, oh my God, this looks like a terms and conditions type of document. So you don't need to look at everything in great detail, but there are just some key things that I'm going to point out to you. So at the very top of the document, it just lets you know that Vanguard are required to provide this information by law so that its investors know the nature and the risks of investing in this type of fund. So this is just a law-abiding document that Vanguard have to put out to its investors. So under Objectives and Investment Policy, it lets you know for this particular fund, the FTSE 100, it employs a passive management or indexing investment approach. So this just essentially means that it is tracking an index. So there isn't a fund manager who is choosing and selecting which investments they should include in this fund. So there isn't a person who has to say, we're going to invest in this company and that company, because the index, which is the FTSE 100, is what it's tracking. So I think I've spoken about this a couple of times on my channel already, but the FTSE 100 essentially is the top 100 companies in the UK. And so this fund is tracking those top 100 companies according to the weightings that the FTSE 100 hold. It may vary a little bit, and they are at liberty to have some kind of variations, but generally speaking, it's going to track the index as closely as possible. Now, if you were looking at the investor information sheet for a blended fund, so a life strategy fund or a target retirement fund, then this wouldn't say passive management. Instead, it would say active management. So that would be something that you may want to look out for. Actually, I'm going to zoom in. I'm so sorry that I didn't zoom in before. I think that's probably going to be easier for you to read. And the next line lets you know that the index is comprised of large-sized company stocks in the UK. So again, it's the top 100 companies, or roughly top 100 companies in the UK. And it lets you know that the fund attempts to track the index, but as I said, they can technically vary this and not fully replicate the index, but they will track the index as closely as possible. Another interesting thing that they state is that the fund may use derivatives in order to reduce risk or cost and to generate extra income or growth. So derivatives are things like CFDs, so where you don't actually own the underlying asset. So you don't own the stock, you have a contract which states that you would assume that the stock price is going to go up, or you assume it's going to go down, but you don't actually own the underlying stock. So this fund can use that type of trading or investing in order to generate some more income for the fund. And so they have to let you know that this is an approach that the fund may take. And another important thing here is that the base currency of the fund is GBP. So if you're in the UK and you're using pounds, it does make sense to invest in a fund where the base currency matches the currency that you're using. Another key point is that it says the fund may not be appropriate for short-term investment. And I think this goes without saying, really, that funds are generally better used and you get the best out of them when you take a long-term investing approach. So if you're looking to put your money into a fund for 6 months, yeah, you may get some gain, but you may also have a loss. So really you should be looking to invest at a minimum of 5 years. Another important point is that the income from the ETF shares will normally be paid out quarterly. This is important to know so that you're aware when your dividend payments will be coming in. So for some funds or some shares, you will be paid on a yearly basis, and some you'll be paid quarterly, and some you're even paid biannually. So it just depends on the fund, and so that's good for you to know how often you'll be paid out. I will also say that it is particularly important if you are investing in an income fund as opposed to an accumulation fund. So when you are going to invest and you're looking at a fund on Vanguard, it will say at the end something like income or accumulation. And essentially, when you are investing in an accumulation fund, any income that you get, so any dividends that you receive, are automatically reinvested back into the portfolio or the fund. And so you don't need to go in and reinvest the money because the fund does it for you. Whereas if it's an income fund, this is not the case. When you receive your dividend payments, it does not get reinvested. So you have to go back in physically and reinvest it, or you may decide to withdraw the money if you want some kind of dividend income on a regular basis. But whatever you decide to do, you have to physically go and do it. So keep that in mind as well. Now we're going to go down to the risk and reward profile. So here you can see that there are numbers from 1 to 7, and 1 represents lower risk, but it also says typically lower rewards. So it doesn't mean that it's completely risk-free, but it means that it is the minimal risk that you can get when it comes to investing. So bonds would be on the lower side of this scale, maybe a 2 or a 3. And as you can see for this FTSE 100, it is rated a 6. So this is a higher risk, but you also have the potential for higher rewards. So what I've seen on Vanguard is that bonds generally sit around the 3 or 4 risk reward level, and indexes or ETFs generally sit between the 5 and 6 region, some on the 4 region. So it really depends on the type of fund that you're investing in, but this is really obviously great for you to know depending on your risk level, what you're comfortable with. Do you want to be as low risk as possible? So should you just be really looking at bonds, or are you happy to take higher risks and potentially get higher returns and sit between the 5 and 6 region? And that ultimately is your decision. Now, the next important part are the charges. So here you get a breakdown of all the charges associated with this specific fund. So for this fund, which is the FTSE 100, there is no entry or exit charge. The ongoing charge to keep the fund going, as long as you have your money invested, is 0.09%, and performance fee, there is none. So for this particular fund, the charges are only 0.09%, so it's a fairly low-cost fund. And last but not least, I think the past performance is something that's really important to look at. So here we have the past performance since 2013, and I'm assuming that, it says here, shares in the fund were first issued in 2012. So we don't have any data before 2012, it's from 2013 onwards. But we can see here how the fund has performed, so this particular Vanguard FTSE 100 fund, and we can also see how the index itself has performed, so the FTSE 100. So if we look at the fund, which is the top line, we can see that in 2013 there was an 18.5% yearly return, and then 2014 it was 0.6%, which is a vast contrast from the year before. 2015 it was a negative 1.4%. 2016 went back up 18.9, 11.8, negative 8.8 in 2018, and then 2019 17.2. So you can literally add these up yourself. So you could add these up over the past 7 years and divide by 7, and that will give you the average return over the past 7 years. Or you can just Google what the average return of this fund has been, but I generally just do it myself with a calculator. It takes not much time at all. And then below the black line you can see the greyish line, and this shows you how the actual index has performed. So in 2013 there was a 0.1% difference between Vanguard's FTSE 100 and the FTSE 100 itself. So it was pretty much neck and neck, but technically the index performed slightly better. In 2014 it was similar, the index performed slightly better. Same for 2016, 2017, 2018 they were literally neck and neck. And then 2019, the index performed slightly better as well. You can see that there's really not much variation in it. So, you know, it is as closely as possible tracking the index, which is important to know. I hope today's video has been helpful and gives you an idea of what you should be looking at when you are looking at the specific funds with Vanguard. And of course, I would say you can still do more research than what that investor information sheet provides you. If you feel like there's something missing or it's not sufficient, feel free to do as much research as possible. I will say that though, don't get analysis paralysis, that you spend so long and so much time doing research into a fund that you never actually get around to investing in the fund. I personally feel that on that investor information sheet, there is sufficient information. As I showed in my third video, part 3, I also use the Hargreaves and Lansdowne website just to see exactly what the fund is invested in. But apart from that, I feel like it's sufficient information. But if you do feel like you need to do more research, then feel free, but just make sure that you make a decision in the end. Now, over the next couple of weeks, I will be sharing my Vanguard portfolio and exactly what I'm invested in and what return have I seen on my investments so far. So if you are curious to know what that is and you like a bit of a nosy and you want to see what I have in my portfolio, then definitely subscribe and you will be notified when I upload that video. But until then, I again thank you so much for your support with this series. I thank you for supporting this channel. I'm seeing it grow and it's just an incredible feeling that people want to listen to little old me. I will continue to bring great content, I hope, and I look forward to seeing you in the next video really soon. Take care and bye for now.